Good afternoon, everyone, and welcome to our webinar on Inside the 2025 Tax Reform. I'm Nikelle Druck, partner of outsourced client accounting services here at Trout CPA, and I'm so glad that you are with us. We have a great lineup in store of speakers today and topics covering important changes made in the new legislation. But before we dive in, I'd have a few housekeeping items I'd like to share with you. You'll notice that your microphones are muted. However, we'd love to hear your questions or comments. So please use the Q&A icon on your screen. They'll be located in the upper top bar. And you can submit your questions there. Don't worry if we don't get to them. We will follow up with you directly as we do have your contact information. And also be on the lookout for an email this Friday from us. It will include a link to this recording of the webinar so that you can revisit or reshare. Now let's get to the agenda. We'll kick things off momentarily with some key highlights on the business tax changes from Robin Bodine. Then from Martha Guaigua, we will take on a few individual tax changes and estate considerations. After that, an overview of state and local tax deductions will be shared by Dustin Peck. And finally, we'll share some actionable next steps and transition into the panel where we'll answer your questions and wrap up around 2:30. We're thrilled to bring you this valuable content, and we hope you'll find today's session both informative and actionable. With that being said, let's get started with Robin Bodine, CPA and partner here at Trout CPA. He has over 3 decades of experience in tax and accounting, specializing in construction, real estate, and trust professional services, manufacturing and distribution industry group. Today, he'll share his expertise on the key highlights of this legislation and business tax changes. Robin, the floor is yours.
Thanks, Nikelle. I think you were just being kind and saying I'm not old, or I am old, excuse me, three decades. So yes, I've done this. I've hard to believe 37 years. Every time I say that, I kind of like, wow, it's been 37 years. So it's been a great career. I appreciate that. And Melina, if you can move us to the next slide, that would be great. I do love what I do. There's been a lot of changes in my career, and the older I get, it is a little harder, I'll just say, because things do kind of get mushed together, like from maybe something that was passed 20 or 25 years ago, like, wait a minute, is that current or is that from way back in the day? So you may have to bear along with me. The 2025 tax reform, it was signed into law on July 4th, right? So it was signed into law. Of course, the Republicans wanted this bill signed by July 4th. And they got, surprisingly, what they wanted. July 4th, President Independence Day, he got his signature on the bill. It was, to me, I was very surprised that we actually got it done by then. And I'll be honest with you, I would have said I was very surprised that we got it done in one bill. Not multiple bills, although I would say that there are some bills that I'm hearing that are still kind of in the works, of some things that maybe didn't get into the July 4th bill, the tax reform bill, that may get passed later this year. It may not. Hard to say. Got to get enough people behind it, obviously, and there's a slim majority, right, of the Republicans holding Congress, so they need every vote that they can get, and sometimes that's challenging. Permanency of key Tax Cuts and Jobs Act provisions. So the Tax Cuts and Jobs Act, that was the 2017 act that Trump signed in his first presidency that created a bunch of tax reductions. And a lot of that you're going to hear, a major thing you're going to hear and see is that things are permanent. And the reason I use quotes, Martha and I, she gave me that quotes yesterday. Her and I have been around a little bit. I've been around longer than she has. But it's only permanent until they change it. So, you may be safe for 2 years, probably safe for 4 years, but in 4 years, we could have a totally different Congress and president. And what was considered permanent is now something else. So keep that in mind. But I do think what it did do is it did remove the temporary provisions inside of the Tax Cuts and Jobs Act, a lot of them, and made them permanent for purposes of, us knowing what they are until there's legislation that changes them. Again, we're going to talk about the enhancements, and, planning is always important to make sure that you're maximizing the tax benefits as much as possible. So Melina, if we can go right into the next slide, I think that'd be great. Business tax changes, if we keep moving here, one more. Qualified business income deduction. You may know this as the Trump deduction. You may know this as the 20% business deduction. I mean, it's got a couple different names that people talk about, but this came about in the Tax Cuts and Jobs Act in 2017. And basically, if you have a pass-through entity, S Corp, partnership, they created this 20% deduction, more or less, on your bottom line that you just get as a deduction as an individual. It's kind of a gimme. The purpose of all of that was to really try to align the tax rates at the individual level to be closer to the C corporation tax rates after you take into consideration the 20% deduction. That was really the purpose behind it. But that was set to expire at the end of this year. And unfortunately, if it did, I mean, fortunately, we got it passed. Unfortunately, it would have been if it didn't get passed. A lot of what we're going to say today is you would have paid a lot more taxes in 2026. So that for the highest tax bracket, a 20% deduction is roughly about 7.4% or about 7.5% of tax savings that somebody in the highest tax bracket gets. And if that would have not been made permanent, then, the highest tax brackets would have been paying at 37% instead of 37% less, basically 20% of 37%, or roughly about 30% tax rate. So, it's just something to be considering as we go through this. There's a lot of stuff here that has to do with taking what was temporary and making it permanent. The depreciation rules, we're going to move into depreciation. That has to do with how we expense capital items, CapEx expenses, fixed assets. For most of our taxpayers, that's anything that's a piece of equipment that's more than $2,500. Like, that's kind of at least a starting point for us to have the discussions of whether it's something we have to capitalize and depreciate. Section 179 was increased. Section 179 is just a code section, and all that is it says, hey, you are allowed to deduct up to a certain amount per year of CapEx expenditures. And when you have over a certain threshold of those CapEx expenditures, then your Section 179 starts to reduce. So prior to the legislation, we were slated for about, I'm going to call it 1.1, maybe almost 1.2 million of equipment for Section 179. That was going to be phased out once you had equipment purchases over 2.9 million. A quick example of this, with the current Section 179 expensing limit now raised to 2.5 million and the phase out threshold of $4 million. If you purchase $5 million of equipment in a year, well, I'm $1 million over the $4 million threshold, so I have to reduce my $2.5 million 179 limit by $1 million. So now my Section 179 max that I'm allowed to do is not 2.5, it's $1 million. So, but the beautiful thing is we now have 100% bonus depreciation reinstated for property placed in service after January 19th, 2025. Again, it was made permanent. Now, my first reaction to this was, what the heck? Why January 19th, 2025? Like, what if anything's placed in service in, the first couple of weeks of January? Well, I guess you're tough out of luck. And what's the importance of January after January 19th, 2025? January 20th was the day that the inauguration happened for President Trump, when he officially takes over. So I guess he didn't want to give any credit. I guess that's the way you can interpret it, to President Biden for 19 days of bonus depreciation. And it's kind of silly to me that we have to worry about 19 days. But that's, to be honest with you, sorry I'm bringing up politics, but it feels like it was a little bit of a political kind of gesture. but it is made permanent. And, you know, the beauty of that is bonus depreciation is something that we take on rental properties where we are not able to take Section 179 on rentals. So rental properties are something that we take bonus on. So that's helpful there. But it is, again, a lot of options there for you to be able to deduct capital items that in the past, those items would have been depreciated over a longer time than 1 year. 100% bonus depreciation on manufacturing property in the United States. So this is a new one. So this has to do with construction. As you see there, after January 19th, there's that date again, and before January 1st of 2029, got to be placed in service by before 2031. And that's manufacturing, basically a manufacturing building that is constructed, meeting those requirements of the dates. And it's only the manufacturing portion of that building. It's not the office portion of those buildings. So you can depreciate 100% of it in 1 year if you meet this period of time that's mentioned in here between January 19th and January 2029 and placed in service before 2031. You can write all that portion of that building off in 1 year versus currently right now that's writing off over 39 years. So again, gives you a great opportunity. You know, I think we are all aware that President Trump is a big proponent of trying to bring manufacturing back to the United States, and this was one of the ways that he was trying to do that. We're going to move on to the business interest deduction. In the past, we were limited to 30% of your interest being deducted. This has to do with taxpayers that aren't considered small business taxpayers. So this would be those over roughly $30 million in revenue that we would have to add back the interest. It wouldn't be deducted if it didn't equal 30% of what was called adjusted taxable income, which is basically prior to the tax law, it was earnings before interest and taxes. Now we get to add back depreciation and amortization. That should help those of you that have some interest limitation that we are carrying forward, that we are unable to deduct because it's an EBITDA, if you're familiar with that term, earnings before interest, taxes, depreciation, amortization. So therefore, the adjusted taxable income is going to be higher in 2025. So therefore, 30% of that is higher. So therefore, it should allow us to deduct more of the interest expense. And if we have an additional amount that exceeds what your current year expense is, some of that carry forward, probably going to get used in the current year and maybe totally gone. So the whole idea behind this, when they passed this bill, was they were trying, back in the Tax Cuts and Jobs Act day, you know, they were going to give it a couple years. They had to raise some revenue. So they threw this in here after, I can't remember the exact date, but they threw in that it was going to be 30% of earnings before interest and taxes. So of course that increases, you know, taxable income. So that was kind of the idea behind it. And it didn't allow some people to deduct interest. And they were kind of like, well, we don't want you to go out and borrow a bunch of money to build, you know, to buy equipment that you're getting depreciation on, that you're able to deduct all the interest. So that was kind of the trade-off of that. But now, fortunately, we're back to, we don't care about how much equipment you buy. It's 30% for your CapEx expenses, basically. We can move on to the next screen, Melina. Small business accounting methods. I want to just mention this. Here we're at the 31 million. I know I previously mentioned 30, so it's 31 million. This does get indexed every year. The reason I throw this in here is you may have seen some stuff from me about some proposals about manufacturing, that the small business accounting method was going to increase to $80 million for manufacturing. That never made it through to the final bill. So if you saw that or you heard about it and you're manufacturing, you know, we can't use things like cash basis of accounting if you're at $40 million in revenue. So that's the reason I threw this in here. I just want to make sure you're aware that there were some things that were thrown around, a lot of things that were thrown around, and this was one that we had sent had some blogs, had some email blasts that showed that manufacturers might be able to, that were over 31 million and less than 80 million, that would be able to use the small business accounting method. Research and development expenditures. This was, I'll tell you, this to me was one of those kind of catch-alls a couple of years ago that was like, really? Again, back in the Tax Cuts and Jobs Act day, they had to find ways to raise revenue. So what did they do? They said, all right, for tax years after 2022, or excuse me, tax years starting in 2022, you had to capitalize your research and development costs, meaning I couldn't currently deduct them like I used to be able to before 2022. And to me, this was just silliness because, in my opinion, America's always been built on, the economy's been built on research and development. We've always been at the forefront of most research and development. And now you're giving less incentive for us to do that. Well, when they passed the Tax Cuts and Jobs Act, they thought there's no way in heck we won't fix this problem before 2022 comes around. Guess what? They never did. I'm sure if we have capitalized R&D costs, you are well aware of this requirement and you're very grateful that it has gone away and is going away. There are some things here to consider though. If you're a small business taxpayer, again, those with annual gross receipts less than 31 million, you have some options. You have some options to amend tax years 2022, 2023, and 2024 to go back and deduct those R&D costs instead of capitalizing them and asking for a refund plus interest. You have that option. It's an all or nothing, okay? You can't pick and choose which years you're going to amend. You have to amend all 22, 23, and 24 if you choose to do so. Now, I know there's probably some people on this call that are like, hey, wait a minute, my return is extended. My 2024 return is extended and it's due September 15th. Can I just go ahead and deduct them? Well, unfortunately, without any further guidance from the IRS, the way the law is written is for 2024, I'm required to capitalize those costs and amortize them. I'm supposed to file a return that way. I'm supposed to pay the tax that way. And then I'm supposed to, if I decide to, amend that tax return. Okay, I get it. It sounds silly. Sounds kind of like dumb. We'll see what happens. I'm hopeful that the IRS will take a more practical approach, but unfortunately, we're probably not going to have that guidance until probably later this year. So we'll have to have conversations with each of you if you're in that boat to decide how we're going to handle 2024. All taxpayers, even those that aren't small business taxpayers, have the option to deduct in 2025 or 50% in 2025, 50% in 2026, or you can continue to amortize the old costs and deduct the current cost in 2025. So you have options. Remember, these are domestic research and development costs. As you can see here, any payments that we're making to an entity that's not a U.S. person or company, U.S. employee, U.S. business that's like a subcontractor that qualifies for R&D, you are required to do a 15-year amortization. There is no change on that. Again, I think this is a theme, with the Republicans and President Trump about trying to incentivize domestic business. So that's the reason why foreign R&D is still a 15-year amortization. We can go to the next slide, please. Excess business loss limitation. So this is one that, if I can kind of explain it in the easiest way, is I have a business, it loses $2 million, it had a bad year. Well, there's Code Section 461 says, well, I can't currently deduct the $2 million. It's limited if I'm married filing joint to $626,000, and the excess over that gets to be carried forward to the next year, and it turns into a net operating loss limitation, which is limited to 80% of your income, basically. So the reason I bring it up is because there was a lot of talk of changing that it would always be considered an excess business loss limitation and not carried over to a net operating loss. And this is actually better that they didn't mess with this and didn't change it. So that it's still there. If you are having losses, yes, we're going to get limited in the next year or in the current year. But as we carry it forward to next year as a net operating loss, we can use more of it than just the 600 and some odd $1,000, the limitation that it is in that year. Now we're going to move into some of the what I would call the energy, business energy. Martha's going to talk more about the residential and I'll say individual energy type credits. These are all business energy related items. You know, at the end of the day, if you step back and you look at this, basically the law was kind of saying, well, we want to take out all this energy stuff to help pay for some of this stuff to make it permanent, because if they're going to make it permanent, they got to find a way to raise revenue. And they took out a lot of energy provisions. Most of the provisions from the Inflation Reduction Act have been removed. Even some of the stuff prior to the Inflation Reduction Act that weren't removed as part of the Tax Cuts and Jobs Act in 2017 are now being removed. And this is one of them. 179D, it's a limited number of people in here that probably have dealt with this, but if you are building a building or you are an architect or engineer on a building, there may be some opportunities for us to basically write off the building quicker for the energy efficient portion of it. This was a kind of a bonus thing for engineering and architectural firms if they were dealing with tax exempt type entities, mainly public type entities. They were often getting a deduction without having to incur the costs of a building. Well, now there's no deduction for property that begins construction after June 30th of 2026. So you got about a year. If you're in this boat doing 179D, this is, I'll say, typically being done by the architects and engineers. That's what we've seen this happening. It's not to say I haven't seen it on new construction, but because it's kind of a way of getting a deduction without putting any cash out for the architects and engineers that are serving these public entities. It can be kind of in a lot of cases, it can be a great solution for them. New energy efficient credit, home credit 45L. This is for our builders, developers. You probably, if you're a builder developer and you're doing a substantial amount of building and development, this is one of those things that you may have at least heard about. You maybe have taken it. Well, now it's for no credit. No credits allowed for homes acquired after June 30th of 2026. Next slide, please. Credit for qualified commercial clean vehicles. This is your business electric vehicle. Bottom line, probably some of you have already seen this. Hey, if you're in the market for an electric vehicle, whether it's for your business or personally, and you want a tax credit, you got to do it by September 30th this year. Credit for clean electricity. This is your business wind and solar tax credits. You know, this is one that I think kind of surprised me that got into the final bill. You know, we've had clients put solar units on their business property numerous times through over the last, I want to say it's been over 15 years that I think the Energy Act was that 2008, I believe. And so it's been a long time that this has been in place, that there was a 30% credit for solar. That's where we mainly saw it. We didn't have a whole lot of people doing windmills here, but we definitely saw it with solar. Well, if you're interested in that, construction's got to start before July 5th of 2026, or the solar units got to be placed in service by December 31st of 2026 to be able to take that credit. The employee retention credit. I'll give kudos here to my partner, Dan Choden, our resident expert and actually, believe it or not, national expert in the employee retention credit, that back in beginning of 2024, or maybe even the end of 2023, was saying, hey, if you got clients that have ERC claims, they better get them in before January 31st, 2024, because that date is going to stick somewhere on some future legislation. Well, here we are over a year and a half later where it has stuck. So, you know, you can't file any claims for Q3 and Q4 of 2021 if they were submitted after January 31st of 2024. If they were submitted before that date and you haven't received your money yet, you should be able to. Assuming you qualify, you should be able to receive your credit. I'm starting to see a couple of mine that were done I had one that was done within a few days of that January 31st, and they received their 2021, I don't believe it was Q3, but it was a 2021 ERC claim. They received that probably about a month or two ago. So IRS is behind, as you can imagine, as they have cut their staff. So it's just taking some time to work through the process. The tip credit. This is a credit that typically we've only saw in restaurants. And basically it's, you know, the owners of the business get a Social Security, Medicare tax tip credit, 7.65% basically on the tips. Now this is being expanded to include the beauty industry. I think there'll be some more definitions on what is the beauty industry specifically. Obviously it's your barber and hairdresser, and it probably includes nail salons, but we'll see exactly what is the definition of a beauty industry that typically receives tips. And this is different than the tip deduction. Martha's going to go over that a little bit later in this program. Next slide. I got to keep moving here. I'm behind. Qualified small business stock. I'll keep this as brief as possible. This is a C corporation that sells their stock that meets certain requirements in certain industries. And if you held it for more than 5 years and it was originally issued to you from the corporation, meaning you didn't buy it from another owner, you were able to exclude 100% of the gain if you held it for 5 years or more. That was the old law. Well, now they've added these exclusions if you held it 3 years and 4 years at 50% and 75%. Again, remember, this is a sale of stock, not sale of assets. And it must have been a C Corp, and it would have been a C Corp from inception. We don't see a lot of that here. This is used widely, I'll say, in the west part of the US, where there's a lot of software and IT type companies that are started up with the intent of hoping to go private or public, or be bought by a public entity. That's typically where we've seen it. It's not to say I haven't seen it here or seen it in other cases, but it's limited. Form 1099 reporting, this is great. We're not limited to $600 anymore. The threshold for services is $2,000. Now you pay somebody more than $2,000 and you got to give them a 1099. You pay them less than $2,000 for services, you do not have to give them a 1099 non-employee compensation. And 1099K, this was set to go to anything over $600 was going to be issued a 1099K. That's basically people that are using service providers, credit cards. This was really trying to go after the gig economy and those that were using Venmo and other forms of payment, to make sure that people were picking up their income and reporting it appropriately. So if we can go to the next slide, and that's all I've got on the business. I'm going to turn it over to Martha. Thanks so much, everybody.
Thanks, Robin. And next up, we have the Miss Martha Guaigua, and I'm delighted to introduce her as the Senior Tax Manager here at Trout. Martha has a wealth of experience in estate and trust administration, small business, and tax. She excels in providing comprehensive tax solutions, including individual tax returns and strategic tax planning. And she is adeptly managing tax notices as well. She demonstrates exceptional proficiency in handling this preparation of trust and estate returns, as well as gift tax returns. Today, she'll cover individual taxpayer changes and estate trust considerations. Without further ado, Martha, the stage is yours.
Hi, everyone. So as Nikelle mentioned, I will be covering some of the key updates to the individual taxation, many which take effect beginning 2025. So if you can go to this slide, great, thanks. So as Robin mentioned, the 2017 Jobs Act was major legislation that made several significant changes to our tax landscape. But the issue with that is that most of them were temporary. So now we have a little bit, this bill has made most of these provisions permanent and made some changes as well. So let's begin with the tax brackets. So the Jobs Act reduced the tax brackets, making the highest tax bracket 37%. Previously, it had been 39.5%. So that is now made permanent. It was due to change at 12/31/2025. I did want to mention that capital gains rates are unchanged at this point. There had been some talks about changing those, but those are not affected. The standard deduction for 2025 has changed slightly and will be indexed for inflation after 2025. Next slide, please. So for those who do not take a standard deduction because their itemized deductions are higher, there are some key changes to take into account. So itemized deductions are made up of several categories, such as medical expenses, income taxes, interest, charitable donations. So we'll go over some of those topics. Let's start with SALT. You might have heard that. Some of you may have heard that wording. That stands for state and local taxes. And what does that mean for individuals? That would mean, you know, if you're an employee, that's your PA withholding, your local withholding, your unemployment withholding. If you are self-employed or have other sources of income and have to pay quarterly estimates, that would be your PA estimates, your local estimates, as well as your real estate taxes. All of that combined makes up SALT. And so the 2017 Jobs Act reduced that to $10,000. This new bill increases the cap to $40,000 for 2025, rising 1% annually through 2029, will revert back to $10,000. There is a phase out, 30% phase out between 500 and 600. AGI will bring it back down to 10,000. So it's never going to be zero. So your best at the highest will be 40,000 for 2025, for example, with 40,000. At the lowest will be 10,000. Regarding mortgage interest, the 2017 Jobs Act changed the acquisition indebtedness limit to 750,000, and this has been made permanent with this bill. In other words, if you borrow more than 750,000 for the purchase of your home, your interest is going to be limited. Regarding charitable donations, beginning 2026, there will be a 0.5% floor that will be imposed on charitable contributions deductions, generally based on the adjustable gross income. Again, that'll be in 2026, so no changes on 2025. Also in 2026, those who do not itemize, those who use the standard deduction, will be able to take a charitable deduction, but there will be a cap. So for individuals, it will be $1,000. For married couples, it will be $2,000. Next slide. Regarding miscellaneous itemized deductions subject to the 2%, it's a mouthful. So before the 2017 Jobs Act, this deduction existed, and some of you may remember it. It allowed for deductions of prep fees, brokerage fees, and unreimbursed employee expenses, but it was subject to an AGI limit. So the 2017 Jobs Act eliminated this entirely, temporarily. This bill makes that change permanent. So they permanently are suspended. What they did do is they carved out unreimbursed employee expenses for eligible educators. So beginning 2026, if you're an eligible educator, you will be able to take unreimbursed employee expenses. Regarding gambling losses, wagering gambling losses are capped at 90% beginning in 2026. So in other words, if you break even, if you have 100 of gambling winnings, 100 of gambling losses, you're only allowed to pick 90,000 of losses, giving you 10,000 of gambling income. The 2017 Jobs Act instituted a casualty loss deduction on federal declared disasters only. That has now been made permanent, and it will be expanded to certain state declared disasters beginning in 2026. The 2017 Jobs Act had suspended any limitation on the itemized deduction. So you take all your itemized deductions totals from all the different categories. And if it was 50,000, then that's what you got to deduct. Prior to the 2017 Jobs Act, there was a piece limitation in place where if you went over a certain amount of income level, your itemized deductions started getting limited. This will be, this new bill doesn't reinstate that one, but does reinstate a limitation for those who are in the 37% bracket. So if you're in the lower brackets, 35 to less, you will be able to take your itemized deductions in full. Next slide. Robin mentioned the expiration of energy incentives. You know, something had to give when these provisions of this new bill have been made permanent. So as Robin mentioned, on the residential side, just we have two different credits, the home energy credits and the vehicle energy credits. So the home energy credits are set to expire at 12/31/2025. There were two types of credits: the energy efficient credit, which was your windows, your doors, your heat pumps, HVACs; your residential clean energy credit, which usually were a higher amount, your solar, your geothermal, your wind. These are set to expire, and can't reiterate this enough, at 12/31/2025. So it is important, if you're considering these types of credits, to, review that information now. These have to be installed and in service by 12/31/2025. The vehicle energy credits are set to expire 9/30/2025. So you have a couple weeks. Again, there were two types of credit. One was if you bought a previously owned clean vehicle, and another if you bought a clean vehicle. Again, just reiterating, these are set to expire. If you're looking at these type of vehicles and you qualify for the credits, because there are requirements, it would be something to consider. Next slide. So now we're getting into some new deductions. The new car loan interest deduction is set for 2025 through 2028 to be effective. So it is a temporary part of the bill. There are some different caveats and requirements. I'm just going to mention a couple of them here. It's up to 10,000 deduction for personal use vehicles. There is a phase out. A lot of these new deductions do have phase outs. So 100,000, 200,000 for joint filers. What is a qualified vehicle? Most passenger vehicles under 14,000, even a motorcycle. Final assembly of the vehicle must be in the US. That was one of the caveats that was pretty dominant as part of that deduction. It does apply to both itemizers and non-itemizers. So if you don't itemize, you can still take advantage if you qualify. The IRS is working on publications and FAQs, which we call frequently asked questions, providing more detail. For example, lenders are going to have to provide borrowers with the information about interest and about their car loan interest. And they're supposed to begin that in 2025. The IRS will probably give them some transitional relief on that. I believe, will be similar to how most people get a Form 1098 regarding their mortgage interest. Next slide. So new deductions for seniors and workers. These will be effective from 2025 through 2028. For those who might have followed the campaign, during Trump's campaign, he mentioned three things that stood out to people, and that was no tax on Social Security, no tax on tips, no tax on overtime. This is sort of the result of that. I just wanted to kind of clarify that there is no change to how Social Security is taxed. Social Security at the highest level, people are paying on 85% of their Social Security benefits. So no change to that. In lieu of that, what they've done is created the senior deduction, which is $6,000 per person, $12,000 if you're married filing jointly, and both of you qualify. It's for anybody who's 65 or older. There are phase outs in place, $75,000 for single filers, $150,000 for joint filers. It is also available to itemizers and non-itemizers. The tip income deduction is not 100% deductible. It's up to $25,000. Employees and self-employed individuals do qualify. It will apply to IRS listed occupations. So there are several known occupations that have tips, waitresses, Uber, DoorDash. The IRS is going to provide a list, so there is no miscommunication on that. So for example, as much as I'd like to be tipped, it's not going to change how I can treat it as an accountant. There are phase outs, $150,000 for single, $300,000 for joint filers. I do want to note that this income deduction is not available if you're married filing separately. There are certainly legitimate reasons to file married filing separately. It's something that can be done from one year to the next. But if you're in that situation, it's a good idea to just maybe talk to your accountant to see what the best avenue would be. It does not affect FICA, Social Security, Medicare taxes. This is strictly income tax. Overtime income deduction is up to $12,500 for a single filer, $25,000 for joint filers. How is overtime compensation defined? Based on what the bill was saying under Section 7 of the Fair Labor Standards Act of 1938. I'm sure the IRS will start publishing and specifying what exactly that means. But in general, it should mean anything over your regular rate. So if you're being paid time and a half, that half is your overtime compensation. There are phase outs, $150,000, $300,000 for joint filers. Again, not available for tax filers who file married filing separately. And again, this does not affect your FICA Medicare taxes. Next slide. The miscellaneous provisions. The child tax credit is $2,200 in 2025, and it is indexed for inflation, which it hadn't been before. Just a reminder that the income phase-out thresholds are $200,000 for single, $400,000 for joint filers, and that is made permanent. 529 plans have had an expansion. Some qualified expenses are now expanded to include a broader range of K-12 costs. Beginning 2026, you can pay up to $20,000 max for K-12 tuition for a beneficiary. That currently sits at $10,000. So it does provide some planning and more opportunities for individuals to use these 529 plans. This one's a new one and a mouthful. Tax credits for contributions of individuals to scholarship granting organizations, which is in place from 2026 through 2029. This is for charitable contributions that people make to organizations that provide scholarships to elementary and secondary school students. The credits shall not exceed an amount equal to the greater of 10% of AGI or $1,700. Next slide. We wanted to mention some information on the Trump account. This was completely new. It wasn't based on anything from previous bills or legislation. The bill does say there's no contribution that's going to take place until 12 months after the bill was enacted, so sometime next year, because it's so new, and I'm sure there's going to be more detail coming through. But here's the basics. Eligible individuals under the age of 18, contributions are $5,000 total per year, will be indexed for inflation after 2027. No contributions after the age of 18. If you were born 2025 through 2028, the government will contribute $1,000 per child into every eligible Trump account. Employers can contribute up to $2,500. Distributions not allowed until the age of 18. Account holders may access 50% of funds for higher education, training programs, small business loans, or first-time home purchases. At age 25, may withdraw for limited purposes. At age 30, the full balance can be withdrawn. When you withdraw it, it is taxable. So from what we're reading, if it's withdrawn for a qualified purpose, it is taxed as long-term capital gain. Otherwise, it's taxed at ordinary income levels. Next slide, please. Okay, so now I'm just going to go over a couple things on the estate and trust side. Next slide. So I always, whenever I speak to my clients about estate planning, I always say it is a team effort. So I always say it's a good idea for them to talk to their financial advisor, to their accountant, to their attorney. We work with a lot of attorneys, and we collaborate to make sure we're all on the same page and doing the best for our client. Next slide. So the 2017 Jobs Act increased the exemption that was in previous legislation, the lifetime exemption for estate tax. And it was temporary, so it was due to expire at 12/31/2025. So some of you may be familiar with your accountant calling you, and your attorney calling you, and your financial advisor calling you and say, hey, this might go down to 7 million in 2026. We need to talk. Luckily that, unfortunately, this bill has made the high amounts permanent. So let's just review a couple of the figures. So for 2025, this has already been established. The estate and gift tax exemption is 13.99 million per individual, 27.98 million per couple. There's an annual gift exclusion of 19,000 per recipient. That's just an exclusion, meaning you can give somebody 19,000 without having to worry about any kind of filings and things like that. The estate tax rate is 40%, so 40 tax rate on amounts above the exemption. So again, if the exemption had gone to a lower amount, it opened more people up subject to this tax. Next slide, please, Nikelle. So here's just some general things to be on the lookout for. And I'm sure as you're going through estate planning and discussing with your attorney, you'll have discussions about. But some strategies is the use of trust, such as grants, irrevocable trust to leverage some benefits, portability. When the first spouse passes away, is there a filing needed to transfer a portion of that exemption over to the spouse? Estate freezing techniques. Consider freezing at a lower value of assets by funding trusts and outright gifting. Reevaluating estate plans based on the permanency of higher limits. So the good thing is, you don't have less than 6 months to figure this all out. They've made it permanent. You have breathing room. You have time to consult with who you need to consult. And so, some things you want to reevaluate. Is it necessary for me to have a trust? Maybe, maybe not. Trusts are not just strictly for tax purposes. It could be for other purposes as well. As always, you want to coordinate your estate and income tax objectives, maximizing all opportunities, especially given that at death, there's a step up in basis and value on assets, and gifting your basis. And that is all I have, Nikelle.
Thank you, Martha. Great job. Next up, we have Dustin Peck. Dustin is a tax manager here at Trout. Dustin handles and supervises all aspects of tax preparation, planning, and advisory for business and individuals, especially in consumer services, construction, and real estate. Dustin is also a leader in the firm's multi-state practice group. Today, he'll be speaking to the state and local tax impacts. Take it away, Dustin.
Thanks, Nikelle. Yeah, you can go through my slide here. I don't have a lot to talk about since this is a federal tax law change, but I just wanted to go over some of the points to note from a state and local tax standpoint. So Martha already talked about the SALT cap, which is an itemized deduction at the federal level, which includes a deduction for your state taxes. And Martha talked about that was increased to 40,000 from 10K, but there's a phase out for higher income levels. I think the key takeaway here from a state and local perspective is that yes, there was some improvement to the deductibility of your state taxes at the federal level, but there's still a limitation, particularly for high income taxpayers. What that means is that the next point here for pass-through entity tax, those regimes are still very much alive. So the pass-through entity tax regimes were created out of the Tax Cuts and Jobs Act of 2017. So when the Tax Cuts and Jobs Act came out in 2017, it created the 10K SALT cap, which limited the amount of state tax people were able to deduct on their federal tax return. And as a result, a lot of the states started allowing you to make an election on your business tax return, on your pass-through business tax return, to treat the tax as a entity level tax and pay it and deduct it on the business return instead of it passing through to your personal tax return where it's going to be limited. So since even though the limitation increased, there still is a limitation. So you're still going to get a benefit from doing that when it makes sense. You just have to reevaluate that and make sure it still makes sense with the change to the 40K. The key point there on that is also there was no change with that. In early versions of the bill, there was a provision that would limit the ability to use these pass-through entity tax laws, and particularly for specified service trade or business, and those provisions did not end up in the final bill. So there's no change to those laws in the final bill. So how does the federal tax change impact the state taxes? So when you are filing your state tax returns, whether it's a business or personal, how is this new tax law change impacting that return in the state tax that you owe? Well, that depends on the state, how the state conforms to federal tax changes. There's three main ways that states follow federal tax law changes. The first is rolling, which means that that state automatically adopts any Internal Revenue Code changes. So some examples of local states. So Pennsylvania, for the corporate income tax side, is a rolling conformity state. Delaware, Maryland, and New York are also rolling conformity. Now that doesn't mean they don't decouple from certain provisions. So for example, Pennsylvania decouples from bonus depreciation, which means even though Pennsylvania for corporate income tax generally follows the Internal Revenue Code on a rolling basis, it does not allow you to take bonus depreciation. Then there's fixed date conformity, which just means that the state adopts the Internal Revenue Code as of a fixed date, and it would take legislation for them to actually move it up to a new date. So that would mean that states that have fixed date conformity wouldn't adopt any of these new changes unless they decide that they're going to do that and update their fixed date. So some examples: local or Ohio and West Virginia. So then there's selective. So some states don't fully adopt the IRC, and they just pick certain things out of the Internal Revenue Code that they'll adopt, or they have their own rules. And some examples is on the individual tax side, the personal income tax side, Pennsylvania has its own very specific rules and does not follow the Internal Revenue Code. So there's not going to be a whole lot of direct impact from this tax law change on the Pennsylvania personal side, similar with New Jersey. The final item here to mention is that there was some potential for a change regarding Public Law 86-272 in the early versions of the bill, but it did not go through in the final bill. So just a quick background on that: Public Law 86-272 is an old law dating back to 1959 that restricts the state's ability to tax you when your only connection to the state is soliciting orders of tangible personal property. And since the internet age, some states have been trying to argue that certain support actions that that business may have through their online websites do not fall under protection of that law. So the early versions of the bill were proposing to add language to that law that would clarify which of those issues might be actually covered under the PL 86-272 protection, but that did not go through in the final bill. So there's no actual change to that law in the final bill. And that's all I had.
Excellent. Thank you so much, Dustin, and all of our speakers. We're now going to turn it to our panel discussion. So all of our speakers are going to come back, and we have to be honest. You guys have been a little bit quiet on the Q&A here, but don't worry. We've got some questions that I have for our panelists. So panelists, the first thing that I have for you this afternoon is, what are each of your key takeaways from this tax reform?
I'll go ahead and get started with that. I do want to have maybe two clarifications to do real quickly here. The 1099 that I mentioned as far as the $2,000 threshold, that's starting in 2026. Unfortunately, that's not 2025. And I'll also note that when Dustin talked about the pass-through entity tax deduction, unfortunately, Pennsylvania does not currently have a pass-through entity tax. So it has been talked about. There's been legislation, but it's never moved forward. We hope that it does someday, but our surrounding states like Maryland does. So but there are some provisions there that may be helpful, especially if you have a decent amount of if you are a Pennsylvania resident or a Pennsylvania business that does a lot of out-of-state business. I've seen that with some of my clients. So I'll circle back to your question. Sorry, Nikelle, I just want to have a couple clarifications there. My biggest takeaway is, I look at this and most business owners would say, hey, Robin, yeah, this is great, but I'm not really saving any taxes because all they did was make everything permanent. And I'm like, well, that's true. Maybe your taxes aren't going down from last year, but the reality is your taxes aren't going up. So what would have happened is your taxes, worst case scenario, could have went up 10% on the same amount of income because you didn't get the qualified business income deduction and if they didn't pass the bill, and you would have had a highest tax bracket of 39.6 instead of 37%. So although there was a lot of things that people would hope for, that they would pay less taxes, we all would love to pay less taxes. We all think we pay too much taxes. We do. Unfortunately, kind of is what it is. But the reality is we paid more if they didn't extend, a lot of these provisions. So that's kind of my key takeaway.
Dustin, do you have a key takeaway? Or Martha? Martha, it looks like you were going to go next. Go ahead. In order.
Oh, I was just kind of following. Again, I just think I'm glad that everything was made permanent, a lot of things. So I think it's helpful to give people time to plan more, especially on the estate planning side. I believe this is, a good thing for individuals. Of course, we're waiting to get more information from the IRS as everything progresses. I don't know that I have anything else to add.
Okay. What about Dustin?
Yeah, so essentially the key takeaway again is that yes, the SALT cap increase, but it's still limited, particularly if you're a higher income, like a business owner, and you're above that phase out range where it's going to drop back down to 10K anyways. You're still in the same place where you can potentially benefit from the PTET. As Robin said, if you have income in states that have that, significant income in states that have that law in place, the Pennsylvania does not. So the key takeaway there is it changed a little bit, but it's not a big impact. You're still having limitations on your federal deduction for state taxes, and there's still room to look at how to address that from the state perspective.
Thank you, Dustin. And I want to just let you know that I did misspeak a little bit. I refreshed the Q&A and I got a few more questions. So it pays to hit the refresh button. So thank you, attendees. One question that I see here is, when does the new 1099 limit of $2,000 go into effect?
Okay, that was what I was just referring to earlier. It's actually 2026. not 2025. So we will update that slide to include the starting date.
So they should plan to do 1099s as we did them in the prior year in 25. And in 26, you'll see that $2,000 increase limit. Next question was around our tax, the tips and overtime. I think that's a pressing topic, Mr. Bodine, for many. There's not a specific question I would say around it as much as, can you enlighten us on anything that we should be doing to get prepared around those tip credits and overtime?
Yeah, so the tip deduction, the overtime deduction, they're actually a deduction on the personal return of the person receiving the tips or the overtime. So you as the employer, your only real responsibility is to make sure that the tips and the overtime is being reported on their W-2. Tips currently get reported for Social Security tips. They get reported separately. I don't know if there'll be a separate another box that will talk about qualified tips for the deduction. Overtime is not. And remember, the IRS has made it pretty clear it's not 1.5. So if somebody's paid time and a half, they're not getting to deduct the time and a half. They're only getting to deduct the half. So it is something to be aware of. If you're using a payroll service provider, I would have to think if it's a qualified one, I am sure that they're going to be all over this and make sure that it gets reported appropriately on the W-2s. If you do your payroll in-house, you need to look at this, and whoever your software is, I'm assuming you're using software, probably are. You need to make sure whoever your software is, it has the capability to report the overtime, probably more so than anything. It's probably more of an education thing with your employees to make them aware that there is this deduction and they shouldn't miss it. Probably they could also consider whether they want to reduce their withholding, because the withholding, I'm not convinced withholding tables are going to get updated. Their federal tax withholding tables are going to get updated for the amount that's excludable from income tax. We don't have a whole lot more clarification except for an email that I and some others here received from the IRS on this. And that's kind of the gist of what that email said. But I would, a lot of people are looking at it going, well, I need to, when the person's paid, they're not going to have federal withholding on that tips or those overtimes. That is not how it works. This is a deduction. It doesn't really change how you address payroll except for how you're reporting it on a W-2. And that has not been, I guess, fully established at this point.
Yeah, and I will say that they will also expect self-employed individuals to qualify for the tip income deduction as well. So we expect that the 1099s will also be updated. I figure some boxes will be changed there as well.
I think the one that's maybe a little going to be interesting to see is how do you deal with tips on somebody who's self-employed? Because I think you're still allowed the deduction. So you have
the key takeaway that I'm hearing from you both is if you are an employee that does receive tips and or overtime, you should review your W-2 very closely. And if you maybe want to seek some advice and counsel from a professional, if you have questions at the end of the year, or I should say early in January when you get your W-2 in 26. Excellent. Well, thank you. And another very, very specific question that I see here is, can you now expense the unamortized patent cost with this new R&D change?
That's a good question. I would say that's something we probably need to take a closer look at. I would say probably not, because I think in the past patents were not considered research and development for purposes, as I recall. So, Nikelle, make sure we find out.
Yep, that individual is marked here, so we can circle back on that question.
Yep.
And then one that is I think this one would go to you, Martha, on the estate and maybe trust side of the house, is what is the impact of a Roth conversion on the senior tax deduction?
Well, like with everything that accountants usually say, it depends. So for those who are not familiar, Roth conversion is when you convert your pre-tax from a pre-tax retirement plan to a Roth, meaning you're going to pay the tax on that conversion. So how does that affect the senior deduction? So the senior deduction does have phase outs. So if that Roth conversion increases your income, increases your adjustable income, and phases you out, you may lose the senior tax deduction. So it is a good idea to, whenever you're thinking about doing these kind of conversions, to meet with your accountant and review if it's something, because you don't have to do you don't have to do the conversion in 1 year. You can space it out. You can, say I'll do it, 2025 and 2026. It doesn't have to be done in all 1 year. So that's when you just want to make sure that you're not losing out on that senior deduction by increasing your adjusted gross income and phasing out because of the Roth conversion. So that's how it could affect it.
And one question, somewhat similar, but and slightly related, was, do you feel, Martha, that the senior deduction sort of hurts the single people?
I mean, it didn't exist before. So I think the issue is the phase out. It to some, it might seem really low, so it will have no effect on them, because it didn't exist before. It exists now, but for some people that phase out might be too low. And so therefore that could be considered like it's not providing a benefit to them.
Excellent. Thank you. The tax credits for scholarships and donation, that is double $3,400 for the joint returns, correct? Was the question.
So that's a little iffy because they do say per taxpayer. But however, the way that the legislation reads, it says it's capped at $1,700. So it's kind of a little unclear. So we've kind of just, at this point, made the note that the cap is $1,700 because they were very specific about that. So it doesn't seem like, even though it says per taxpayer, it's treating married filing joint return as, each taxpayer qualifying for the $1,700. As far as I was reading, Robin, I don't know if you had read anything different.
I would say I can't say I've seen anything that's clarified that. Unfortunately, I think there is some ambiguity on some of this stuff.
Mm-hmm.
And I think we'll just have to see what clarification comes out here in the next several months.
Thank you. And then it looks like one last senior deduction. Does the senior deduction apply to Social Security disability?
So again, that deduction it's not really related to Social Security. It's kind of an additional deduction on your tax return based on meeting the criteria, which is you're over 65. So it'll be a reduction in income. So if you don't have any income to report, it's not an additional, there's nothing, there's no deduction to it.
Got it. Thank you. And then here's one. Can we have more detail on the calculation of overtime per the new legislation?
So like Robin mentioned, you already kind of know, like your pay stub kind of tells you, hey, this is your regular rate, this is your overtime. Your overtime includes your time and a half rate. So if you so your regular rate is $10 and your overtime is $15, your overtime compensation that would be reported on your W-2 is based on the $5, not the $15. And that's in general. Like I said, when the bill was passed, it noted that it's overtime compensation defined by a certain act of the Fair Labor Act. So we might get more detail on it, but in general, we believe that that is how it's to be construed.
Thank you, Martha. I'm going to ask one last question. If nobody has any further questions from the Q&A, and this is for manufacturing, so teeing it up for our manufacturing specialist. What are the most impactful changes in the tax reform regarding equipment and capital purchases for commercial customers and also new manufacturing facilities?
So I would say, the biggest impact for anybody that's in manufacturing is just the depreciation, that we've got this enhanced depreciation for, especially if you're a large manufacturer, you're now able to deduct 100% through bonus depreciation on the manufacturing equipment. Meaning if you're buying $10 million worth of equipment, you're not going to be limited under, you're going to be limited under Section 179. So you can't take Section 179 to expense all of it. You have to take bonus. But you wouldn't have been able to do that if the bill wasn't passed. You would have been limited to 40% in the current year, 20% next year, and then 0 in that example. So that's really, it's a lot to do with, in my opinion, has to do with the depreciation, has to do, if you're doing, I talked about the manufacturing facility, that there's a 39-year asset on the manufacturing property that you would be able to deduct right up front, if you meet the requirements, as I went through there on the slide. So that's what's impactful, I think, to manufacturing, and possibly to the interest limitation. You're not being subject to as much of your interest being limited because it's being calculated on a higher number. So that's how I'd kind of define it.
Thank you, Mr. Bodine. And I think there's one last bonus question. I know I told you there was one more, but I think this one is very much worth covering. It might be worth all the admission tickets that we have. So we're an S corp before the legislation was finalized. I read that that as an LLC structured as an S corp are not optimal with the new changes. Does this still stand for the finalized version? And if it does, what options do I have?
Well, I think the way I'd answer that is if you are an LLC and you elected to be an S corporation, I can't think of anything. Dustin and I were thinking of some things earlier on this question because I think it came through with the invites, accepting of the invite. And the reality is there's really no downside before or after this tax law of you being an LLC taxed as an S corp. You have to remember, though, what I would say, anytime you make these elections, getting out of the elections are not necessarily tax-free. Okay, that's all I would say to that. Meaning, if you decide I don't want to be taxed as an S corp, I want to be taxed as a sole proprietor now. Well, now there's probably a discussion of that decision probably creates some taxable event that is phantom income that you will not be happy about. I'll put it that way. So, but I don't see how there's any changes between what was before and after that affect LLCs that are electing to be an S corp.
Excellent. Thank you, Robin. Well, this concludes our panel discussion, and I want to thank each of you today for joining us this afternoon. We hope that you found this presentation to be informative and helpful, and I want to express my sincere gratitude to each of our speakers today and for sharing their expertise. If you have any questions related to what you heard today, please reach out to your Trout CPA professional, and they would be happy to assist you. As I mentioned at the beginning of today's webinar, we will be providing a link to this recording, and you will receive that in your inbox tomorrow afternoon. Wishing you a wonderful rest of your Thursday and a relaxing weekend ahead. Thank you again for attending. Have a great day.